Hello and welcome to another episode of Exchanges with me, Evan Lucas. A question that you guys have been actually asking me over the last couple of weeks is around businesses, unicorns, funding and how funding works, and where we're going in this country, particularly around debt facilities and debt marketing. So who better than to get on somebody that actually does this for her own business and career? So that's why I've got in the fantastic Jodie Imam, who is the head and co-founder of Tractor Ventures. She's also a very, very big advocate for women in business and women's growth. So with that in mind, here's this week's exchanges around how venture capital can help your business. Jodie, welcome to Exchanges. I've been waiting to get you on for quite a while because I've been watching what you do at Tractor Ventures very, very closely for at least a year now. And congratulations on what you've done and how you've done it. But the other reason I wanted to get you on here is because people see you as a little bit scary, I think is the way to say it to you. So can you take me through, you're technically in venture capital, but that you're not the venture capital that everybody thinks about when they hear that term.
Yep. Well, firstly, thanks for having me on the show. It's a great opportunity. And secondly, I find it very jarring to think of myself as scary. Do you know I'm only 5'6"?
Yeah.
um,
But you operate in that world, right? There is
yes.
that sort of this idea that venture capital is for big equity players, that, you know, the business may have to give up control, that, you know, if I'm doing my startup, you know, where do I lose that sort of entrepreneurship coupled with, you know, business return and the whole concept that comes with a shareholder? You're not that though, are you?
Yes, exactly. So it's a funny thing, and this is my third sort of business in this world, and it's like you sort of wake up one day and you say, I want to be an entrepreneur, and then you find out about startups and you learn, you start to read all the media and you start to know the ecosystem. And then the next thing you seem to have this playbook which says, now I must go get some VC funding. That's been the playbook. And it's been, it's been a helpful playbook up until now. And I've been in this ecosystem for nearly 15 years, and up until, back then there wasn't much of an ecosystem. Like, it's grown a lot. And so has the VC, um, the money, the capital, the number of players, it's grown a lot, and it's helped us build this ecosystem, which is awesome. But to answer your question, we're not VC, and we're called Tractor Ventures because we're not for the rockets. So the rocket, we talk about the rocket, and some of them are exciting and they land on the moon, but they're also very expensive, and a lot of them blow up along the way. And over my time and my co-founder Matt's time, we've been in the ecosystem as in roles of advising, mentoring, running accelerators, all sorts of things, working with a lot of startups, and we've seen a lot of that carnage over the time, and that's where the idea for Tractor came up, just to provide another type of capital for founders that are not necessarily wanting to get to the moon, not wanting to be ringing that bell at the NASDAQ, but maybe they want an outcome which is, I don't know, they sell the business for $50 million and they still own most of the company. Maybe that's their outcome. It's businesses that are growing at their own pace, and it's technology that their customers really rely on. So if you said to the farmer, "We're sorry, we're taking away our tractor now," he's most likely going to he or she most likely going to get a bit upset about losing that automation. So that's the kind of businesses that we're here to support.
So with that, you more work on the debt side, right? So you're
Yes.
actually, I think what people don't see you or understand what Tractor does, or people that work in your part of the capital world, is that you're actually providing debt facility
Yeah.
that is much more open and much more, fairly simplistic compared
Mm.
to some of the structures that come with the equity side.
Yeah.
So why would a business come to you for that side? Talk us about the debt first and how
Yes.
you operate the debt,
Yeah.
and then why a business should look at someone like Tractor and your competitors over, as you said, trying to reach the moon, going down the venture capital route and everything else that comes with that.
Yes. Yeah. Great question. And so when we started Tractor, we didn't know anything about running a lending business at all. We definitely came from the
Standard.
founder side, and
Yeah.
we saw the gap. We wanted to provide a different type of capital, and so we launched with this revenue-based finance type of loan where you would pay back the loan as a percentage of your actual revenue, so that if you had some peak months, you've got money, you could pay it back. If you had low months, then it's easier to pay back. We also had a little bit of dilution there where we had some warrants, which is typical of like a venture debt offer. But as we've gone on, we've learned that all of that stuff just is very complicated. So you said it exactly the way we see it now, which is simple. And what it is just think of it as a business loan. It's a basic principal and interest loan that you can spread out over 3 to 36 months, depending on what you need it for. It's a set repayment. You know at the start how much it's going to cost you, and you pay it off equally over time. So that's really what we've boiled it down to, is the most useful for founders and the easiest for us to be able to build up a loan book. So we've now deployed over $85 million to over 230 tech founders. And so, it's definitely, there is a gap. We thought there was a gap. There's definitely a gap.
There's definitely a gap. And that's, again, why I loved and wanted to have you to come on to this program, because in Australia, we have a really immature market when it comes to this. We don't actually have, it's either a massive international player or sort of you then have to go to the bank and the bank has a lot more overlays, much more reg, and a fairly easy ability to turn around and give you a big fat red stamp that says no. So that is also the next thing to discuss is Australia's market maturing? Is there more opportunity to sort of look in that debt space? Because again, one of the things we keep hearing about in this country is productivity is not moving. We're not as adventurous as we once upon a time were. The founder mentor, the entrepreneur mentality that we've been sort of hearing about and needing. Is it more players like yourselves that can fix that? Or is there other things that you think also could come to market to really start to get Australia supercharging itself from being what we are known as, which is a country that basically puts a hole in the ground and pulls rocks out?
There definitely is. So I think, in reference to the banks, like we think of ourselves as we exist for those companies that are a bit too spicy for banks, but not spicy enough for VC. And so the bank process, and just even today, one of our customers applying for lending is just like, we said, oh, we're sorry, we've got so much in our IC queue at the moment. It's going to take us 4 days to come back to you. And they're like, that's fine. Like the bank will take some months and then it's probably a no. And then they might take your house or your firstborn or something else to secure against that money. So whereas our lending is unsecured. So
okay, just sorry to jump in on that. Just take us through the difference, because I think that's also sometimes lost, that you're an unsecured loan, whereas banks will want something as collateral, yes?
Usually, yes. Yeah.
So how then, from a risk perspective on your end, does that work for you? Because when a client or particularly somebody out there listening hears an unsecured loan, their question will be, well, then why are you giving me the money?
Yes.
Walk through why it's unsecured, and as you said at the start of this, about how it works with the revenue that you generate.
Yeah. So the reason we're doing it is, again, from that founder empathy. Like, we just wanted to provide funding that would help a founder, having been founders multiple times ourselves. And so we know as founders, we don't want to put our house on the line. Like, this is already risky enough. We've already got our spouse saying, when are you going to start earning money? When are you going to start? When is this going to pay off all of this hard work? All of these things. So you don't want to have your house on the line for this either anymore, like if you have in the past, or you've already put your life savings in or whatever. So you want to start to eventually separate out that risk for yourself personally. The way we can do it in our structure is that it's a higher interest rate than you would get from a bank. So we will say to a founder, if you can get a bank loan, we're stepping back. You go do that, because if that suits you, it's definitely going to be cheaper. I mean, our loans cost on average between 10 and 13% as a simple interest rate, which is about between 20 and 23% roughly as an effective interest rate, depending on the term of the loan. So
that's
more
a
expensive.
18-month to 36-month term by the sounds of that?
Yeah, that's right. Typically it is, yeah. So that's how we can fund it, so that if we do get a default, then we've got that sort of built in to our revenue model over time. So, but we've got a fairly rigorous assessment process And we know tech companies, and we can look at a tech business and understand the risks, we think. And so far, so good. Touch wood.
So that's the other part of the debate that I get to have in my sort of bigger macro world is for someone like your firm and how you're operating in this space, which I think is really, really exciting, is the funding markets becoming a little bit less difficult, or is it still, in your view, really, really tight and having to get, the capital access to whether it's the bank plus swap rate markets or whether it's other debt markets, whether you have to go through hybrids or other things? Is it starting to become a bit more accessible now that internationally rates have come down, and same here in Australia?
Well, I think actually, because I didn't actually answer the second part of your last question, which was about the growing space for this type of product and the debt market growing here. And I don't know if you saw the Cut Through Ventures report that just came out a couple of weeks ago, which summarizes the state of funding in the startup ecosystem. And, that we had a lot of commentary around venture debt and how we're still about 2% of uptake of venture debt in this ecosystem, as opposed to the US and other mature markets that are between 15 and 20%. So there's huge scope, and there's already more players. So there's, when we started, there was kind of one other RBF lender. Now there's a few. There's some great venture debt companies in the mix, and there's more coming up. There's a lot of private credit as well. That isn't the problem. Getting the actual wholesale debt is not the problem. It's just getting the understanding and the adaptation. Sorry.
No. And so I think that's also what I know from the research that I was doing, leading into this interview and to doing this exchange is, as I said at the start, there is this idea that it's still debt and it's
Yeah.
debt overhead. It's not, you then have to back yourself, and there's a behavior behind that as well as understanding, am I able to build this business and scale this business to the level that I think it can achieve? Is the angle of going through debt rather than equity the option for me? What do I do? And how do you, deal with a client on that perspective? Because again, from my world, coming from the behavioral world, so many businesses, particularly micro and medium-sized businesses that are, at that scale point, don't know when or how to take that step because they've pretty much funded it straight on cash.
Mm.
They believe that that's what they need to continue to do so,
Yeah.
and they either hit the ceiling where they can't scale further,
Yeah.
or they start to realize that their cash is now running out. The cash flow cannot continue to sustain the business.
Mm.
When and how do you get to that point with a client to change the thinking, to change the behavior that, what you're adding to them will be scale rather than actually a possibly seen as a burden?
Mm. There's so much in there. I think
Sorry.
Oh my God, I've got about 3 really solid points here.
Yeah.
Firstly, we've got a fun statistic that we flash around, which is, and I think this is one of the understanding parts that we're still working with, is that founders think that selling shares is cheaper than taking debt. And so, because debt, you need to pay back straight away. Whereas if you sell some shares, then you have to pay back that investor maybe one day, way down the track when who knows what happens. So we don't think about it. But actually the investor expects, from an angel investor through to VC, expects quite a large return. So in comparison, if you can compare it to an interest rate, it would be like a 400% per annum interest rate is the expectation that investor has for you to pay them back down the track. So first thing is to break down that sort of understanding that, taking on equity investment isn't free. It's actually very expensive. And if you do get this thing go to where you want it to go, and then you have to pay back these shareholders, and if they've taken a lot of money for a small amount of money at the start, a lot of shares for a small amount at the start, then suddenly you're paying them millions of dollars, whereas you're only ever paying us, tens of thousands.
20% on principal, right? So
That's it. Behaviorally, though, it's interesting. We've actually just launched a survey with Smart Company to ask founders, because I think the behavioral thing is something we come up with against all the time. And it's this, mum told me not to take debt. It's bad. It's credit card debt is terrible, but it's trying to teach that or educate that putting a TV on your Amex is not like using debt to leverage growth in your business. They're two very different things. So it's separating out those understandings, behaviors. Yeah.
Yeah, whenever I get that question at me, the way I describe it is debt is like having a power tool. If you use it correctly, you'll build your house 10 times faster than if you had to do it by hand. But if you use a power tool incorrectly, you'll take your fingers off. And so that's all it is, right?
Yes, that's a great analogy.
Yeah, all gearing is understanding that you are accelerating the process with a tool that can actually really move you. But again, as you said, the psychology of it is there, and I agree with you. Particularly when you talk to a generation, maybe like Generation X, or you talk to a Boomer generation, they do see debt in that space. I also now wonder, and part of the next part of the discussion is how the millennial generation, which I know would probably be quite a reasonable mix of what your clientele are in terms of the age group, that sort of 30 to 45 group, and maybe even up to 55, so Gen X as well.
Yeah.
With the perception about what's happened with rates just from the cash rate over the last 13 months, disregarding what happened in February with rate cuts.
Yep.
Did you see an even bigger shift in that concern around, debt, where interest rates were going through, cost of living was really putting a pressure, and that pressure on the business that they were putting their blood, sweat and tears into amplified? Was that
Yes.
part of the other part of the problem?
Yes, although that interest rate hold, if we think that there hasn't been a raise in 4 years, well, we've existed over 4 years, Tractor. This is our 5th year, and we've seen enormous growth and then a slowdown. So it's interesting. It's not just the interest rate, I think, for founders, because in 2021, there was all those frothy valuations and huge, fantastic exits and all sorts of great, capital raises happening. And then in 2022, that just died. And so for us, that's when people turned to debt because they, one, didn't want to sell shares at half the valuation that they were talking about the year earlier, or just weren't going to be able to, but still wanted to grow. So, we had a huge year, 1,000% growth. But then I think over time, that grinding slowdown in the economy then starts to just affect everyone. So the consumers struggling to pay things. So then the businesses and the enterprises, it's all slowing down. And then our customers, who are mostly B2B, it's contracting for them because it's taking them longer to sell their thing and longer to get that money in when they have sold it. So then, we saw a lot of cash flow crunch, especially last year.
So then on the flip side, let's go back to what happened in February with the rate cut and that change.
Yep.
It's very interim, and I understand that. Has there already been a change in your clients' sort of mantra around their thinking? Are they starting to actually sound like a positive outcome for 2025? And are you seeing any changes in terms of, more interest in your world?
Yeah. You've probably seen it too. I just think generally everyone started this year determined to be more positive. So there's this positive energy everywhere. So it's definitely started that way. We're in an IC meeting this morning, and one of our analysts made a comment about, it's really interesting over the last year, we've seen a big switch in all the people that we've assessed. So we can't always approve every single loan. So we've seen hundreds of companies, and we plug into their Xero, so we see all their accounting and all the trends. And interestingly, what we were seeing a year ago was growth. And in the last 12 months, especially, that there's been a massive shift from the founders and the management of these companies. They've turned off the growth to turn on the profitability. So it's really interesting. There's been there's a real trend of, instead of just growing and burning as they grow, it's like, let's just focus on the cost. Let's get to profitability and a stable, sustainable business. And we've seen like the revenue flatten, but the costs absolutely shrink, and then the profitability start to come through. So that's where the focus, I think, has been across the board.
Yeah, that's really interesting, because that's what's happening at the bigger end of town. I mean, that's what we're being told with what is being seen in earnings seasons, what's been seen in most of the the big private debt discussions is that it's clearly been a cost consolidation period, which is fairly typical during a higher interest rate environment.
Yeah.
Yet employment hasn't moved that way, which is probably also quite an interesting discussion. Are those same firms that you were alluding to with regards to the profitability move up? Was the consolidation around headcount, or was it around operations, or was it also about basically streamlining their product and getting their product, tip top rather than just trying to keep scaling it? What was the change in that actually drove
Yeah, I mean,
that
I think it's
profitability?
probably all, but in all the discussions that I had with founders, I think, and we also went through this as well, late 2023, we had to make some redundancies, and I think that's when there was a lot of that kind of contraction on the staffing side happening, and no one wants to ever do that again. Like, no one ever wants to do that again if they've had to do it. So I think that the focus has probably been on not rehiring too quickly and just trying to get other efficiencies out of the business, because just moving staff in and out is not great.
The other question I have to ask and sort of talk to you about is, we've also just been through a period of the highest rate of insolvencies that Australia basically has seen. What do you see in those insolvencies that may or may not have been able to get them through this period better? Was it the fact that they had gone down the equity route? Was it that they, again, were using cash flow as the way to fund their entire business? Can you look through at what you've been seeing in the insolvency side and possibly, I know it's a hard word, but the correct word, the mistakes that have been made that have led to that decisions?
Hmm. I mean, we have a small number of companies that have gone into liquidation that we've dealt with directly, so it's a small sample size, but it's a real mix. It's a mix. I think, sometimes it's actual relationships, like founder breakdowns is a common thing that happens, and then the focus is gone, and the desire to keep driving the business ends up running the business out. There's been sort of product recall sort of situations that's just caused massive problems. I think also there is just a general lack of financial literacy. Like,
Yeah. And I was hoping you would get to that point, because that's what I've seen too. And the discussions I've been having through this podcast and doing what I do, it all comes back to the fact that Australia suffers from a really, really bad financial literacy deficit.
yeah,
That's what it is.
yeah,
And it's fascinating to see just how resistant, particularly the education sector, is around putting financial education into the system. I mean, it's the only maths and economics that you will take with you for life. Once you
um,
leave school, the probability of you using calculus or algebra is pretty low, unless you go into engineering or you want to be an astronaut.
uh,
And I think this is the point that I was hoping you'd get to, and I sort of knew you would, with what I've been seeing with the insolvencies is exactly that, is that, they are more likely to be in retail or a product or a widget that all of a sudden has got popular real quick and
um,
has blown up, whether it's through e-commerce or what have you. And then they get to this point that they don't know how to actually deal with the cash flow, to deal with the balance sheet,
uh,
to look at someone like yourself and sort of scaling the business.
uh.
How do we get better with financial education? What is it that we need to do as a nation to actually get better at this spot? Because I'm with you. I'm really passionate about this, and I think it's where we are lacking.
Yeah. Oh, definitely. I went off and did a master's in financial management in my early 20s, because I realized no one's taught me about money, and I figured I needed to know about it. And that's an extreme way of doing it, but I think it's definitely in our education, and it's starting to come through. My son's in grade 10 in a public school, and he's got a subject called Money Matters, and it's some business fundamentals in that subject. And so I think there's like dribbles of it, but it's education. It's
Yeah,
yeah,
and
even primary school.
even primary school. But do you
Yeah.
think it's also culture? Do you think that we in this country have still a big cultural issue around making money and about actually, you know, being a unicorn or
Mm.
being that business that can be sold for $50 million into the future.
Oh,
Do you think that's the other thing that you come up against time and time again is, or that's a little bit too, aggressive,
um,
assertive, aspirational for the culture that I sort of work in?
yeah, I think so. If you dig into the psyche, I think we're definitely a culture of holding ourselves back from financial abundance.
Yeah. One of the biggest learnings I think I've ever had was watching how Americans think. The US is incredible with that. Like,
Mhm.
they have that term, back the billionaire. They'll actively throw
Yes.
finance at the billionaire, even if the billionaire's, you know, possibly slightly crazy. It doesn't matter. They'll back them in. And they'll
Yeah.
even back in an idea that could be, so risky it would make your head spin, but they'll back
Mm,
it in. It's something
mm.
that we don't have, is that tall poppy syndrome, again, I think is part of it, but also it goes back to the financial literacy question. So the final question that I normally ask everybody on this podcast when I do this, Jodie, is if you were in charge for just one day,
Mm.
what would you do?
Well, I think having
Massive
just
question.
yeah, it's a massive question. It's one of the things that's been sort of at our in our minds since the start of Tractor as well, which is I'm very passionate about, and I support a lot of women in many ways. And I think if I could have some sort of impact on the redistribution of wealth and gender equality, that's what I'd want to do.
Very, very good way of finishing this. So, Jodie, thank you so much for joining Exchanges.
Thank you so much for having me.
So there you have it. I hope Jodie really has broken down those barriers about joint ventures with players like venture capital can actually be a good thing, that scaling is possible for businesses of all shapes and sizes, and that debt isn't actually necessarily a bad thing. I'm really glad also that she highlighted how much financial illiteracy in this country is a problem and that we need to do more to get it ahead. But with that, I want to say thank you to Jodie, but also to remind you guys, please don't forget to hit subscribe. The more subscribers we get, the more guests that I can get in and the more discussions and exchanges that I can have with the people that you want to hear from. So again, thank you so much for listening, but please give us that subscribe or give us that 5-star rating so we can keep doing this going forward.